Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. The Citi China Conference is underway in Shanghai, and in a moment we'll go there for a conversation with Citi CEO Jane Fraser. Now, this will happen against a backdrop of equity market weakness today across the Asia Pacific following a sell-off in the States. Today's Fed speak was hawkish, and valuations do remain a major concern, especially in big-cap tech. We got some perspective from the APAC with Billy Leung. He is investment strategist at Global X.
If you look at the AI names or even the tech names, it's actually quite solid compared to, for example, 20, 25 years ago. And I think a really, really good sort of view is that if you look at 20 years ago, looking at the NASDAQ, over 70% of those companies at that time was probably at negative free cash flow. They were probably unprofitable. They had net debt. But if you look at right now in terms of the NASDAQ companies, that's sort of opposite right now. We flipped it over. 70% of the tech companies in the US right now are actually profitable and having positive free cash flow. So we are in a much more solid fundamentals and quality. So I would see that as more of a justification of why I guess valuations are much higher right now.
That was Billy Leung, investment strategist at Global X. We also learned today that China's economic activity cooled more than expected in October. There was a slump in investment and slower growth in industrial output. Now, retail sales did top estimates with annual growth of 2.9%. However, month on month, retail sales slowed for a fifth straight month. Let's go next to the Citi China Conference. Here is Bloomberg's Stephen Engle for a conversation with Citi CEO Jane Fraser.
So what do you hope to get out of this? And when talking to all your guests and your clients and to understand a little bit more about the China market, which you know very well, but we're coming out of a bruising trade war. We're not even out of it yet, right? Some say it's a truce, not necessarily a lasting peace. What have been your takeaways so far?
I think what's interesting this time at this conference is that it's moved away from a China for China story. And instead, we have had huge interest and a large number of investors and companies coming to China to understand what is happening here, as well as the Chinese companies and investors that are looking much more externally now. Yeah. So that really feels like a sea change here that's pretty exciting. How
do you serve your clients against the backdrop of two governments that are trying to de-risk, if not decouple?
Look, I think the recent truce has brought some much needed and welcome stability here. We're in a position now for both sides that wanted to have a period now where we can move ahead and have a more stable relationship between both of them. It's transactional, but it's in both sides' interests. And we see our client base navigating this well.
Yeah. What's your vision for the China market as it folds into your overall restructuring plan as well? You're now chair and CEO. First time that those two roles have been joined in a couple of decades. Clear mandate to carry out your vision going forward. What does that look like when you did exit your consumer banking business here, like you did in many markets around the world? You also sold your retail wealth management portfolio to HSBC. You got out of an investment bank JV with Orient Securities, I believe, and you have an outstanding license application for your wholly owned JV in securities.
So Citi has been in China for 124 years. We have a landmark building here in Shanghai. And what we have done is focus our strategy and grow. We are following our international clients around the world. We're seeing them with renewed interest and focus in China, as we talked about. And then we're seeing the Chinese companies innovating at pace and also looking at expanding internationally. So we've been growing rapidly here with a more focused strategy. And it is the power of clarity and renewed purpose in the firm.
Now, before this interview started, you really countered what I said is you're pulling back a little bit from China. That's not at all. You're adding headcount. What are your headcount numbers when we get headlines that your IT department, maybe 3,500 jobs are going to be moving elsewhere and this and that? You pulled back from retail 3 or 4 years ago.
Yeah, I think you're getting the story wrong.
Good. That's why you're here.
Citi is on the front foot.
Yeah.
We are innovating. We are growing. We're helping support our clients. Our clients are both building resiliency and they are reinventing themselves with all the technological changes. That is no different in China than it is in other parts of the world. So no, this is a firm with clarity of purpose, with clarity of direction. We know where we're headed, and we're really delivering strong progress. So I'm excited by the upside that we have. I'm excited about the progress we're making. And I see it here on the ground in China. If we move away from some of the just headwinds that we all know about on consumer spending and on the property market, and you look behind that here in China, it's a manufacturing powerhouse.
Yeah.
What are we seeing? 50% of all robotic companies in the world are here in China. China is writing the next chapter of its economy around advanced manufacturing, around innovation, as well as more Chinese companies expanding internationally. And we're both serving 70% of the Fortune 500 that are here in China, as well as serving the Chinese companies locally, tap into global markets.
So how does that equate to what the deal flow you see? Vis, who's the head of global banking, who we talked to a couple of hours ago, extremely bullish on the amount of deal flows going into 2026.
Yeah.
What kind of cross-border with China do you see?
Look, I think we're seeing new corridors opening up. And the scale of ambitions, not just in China, but in Asia, are higher than we see really in many other parts of the world. So in these new corridors, we're seeing the Middle East connecting with Asia. For the GCC, they were expecting Asia to be its largest trading partner by next year. That's an entirely new set of flows in the last 5 years. Brazil's connection into Asia and into China, again, very robust. They're major partners. So, the world is changing rapidly. It's adding new corridors, it's adding new flows, it's adding new wealth, and scale is the name of the game.
What will be your strategy with wealth management? As you got out, as I said, the retail portion of your wealth management was sold to HSBC, but you're going to be onshore here. But you're going to do a lot of it from Hong Kong and Singapore, right?
So Citi is focused internationally, not on retail banking. We are focused on serving clients who have cross-border needs. That is a very vibrant but segment of clients. Think of individuals that are driving the mid-market companies that are growing internationally. We think of the world's billionaires and wealthy that need access to global markets. And then we obviously think of investors and corporations that are doing so. There's a lot of engine of growth. It's going to be 50% of all of the new high net worth households created in the next 3 years will be created here in Asia. So our focus is on what is the wealth proposition for those, as well as supporting the companies and the engines of growth behind them.
So what kind of hiring is going to be needed in this part of the world? Not necessarily China, but the rest of Asia. At a time when we're also seeing corporate America, as they invest heavily into AI, they've had to pull back on hiring and jobs have been cut.
It's a great question. I think AI is certainly changing a lot of what we're expecting we're going to need in the world going forward. So from Citi's point of view, for example, we see this as an opportunity to really train up our talent. How do we empower our talent to use the AI tools so they can be smarter in front of clients, they can spend more time serving clients and coming up with solutions as opposed to the more chore elements of being a banker. We don't know how quickly it's going to change, Steve. So there'll be certainly a lot of shift in coding jobs. We've seen that already. Our productivity is up 9% year over year for our coding teams. but there's going to be new jobs created too. None of us quite know yet exactly how the timing will play out. We know there's a lot of change ahead of that, but our approach is we're going to invest in our talent. Our firm is growing, and that should be able to support the needs going forward.
You mentioned the Middle East. I think you just came back from Riyadh. You're co-chair of the U.S. Saudi Business Council, I believe. This also very bullish on India. Magnificent opportunity there.
He's biased.
Might be a little bit biased, maybe. But again, what do you hope to get from those markets as it fits into your restructuring plan and the vision that you just talked about?
No, the growth plans that we have going forward, because we are on the front foot. I cannot stress that enough. And you can see it in our results. So all of our businesses, we're taking share, we're growing very quickly, and our returns are improving. So as we're looking forward, it's growth. Let's take India. Citi is larger in India today. We are the largest foreign firm by revenues in India. When I look at Korea, where I was just at, that's another market where we were the first foreign bank to open the doors in Korea. And we have a very strong position there supporting multinationals and clients. So as I look around the world, it's becoming more focused on diversification. There is also a focus on reinvention. What we are doing is helping provide the strategic advice. We're helping provide the financing and structuring and arranging that. And we're also helping manage the supply chain reconfiguration. We're helping with the hedging in foreign exchange, interest rates, because volatility is a feature. It's not a bug of this system.
Through your restructuring, you had to get rid of the retail side. And are there other areas that you would like to divest? I know
you have the wrong story. Citi is about growing. We're very clear.
Front foot forward.
We are very clear on our strategy, and we're moving onwards.
I only ask because, again, the Russia situation is a little bit different probably than your overall strategy. We just got word that Vladimir Putin approved the sale to Renaissance Capital of your bank in Russia. Probably something that you've been wanting to do for a while, but it was held back.
We have been winding down, as many companies have been, the franchise in Russia. We were waiting for the final approval to be able to sell. We've got a couple more to go to Renaissance, but it's a tiny business. So it's in the grand scheme of where Citi is, where we're investing, and what we're doing. It will be good to get that done, but it's not critical to the firm's strategy going forward.
Let's talk about the outlook in the United States right now as we head into 2026. We saw the market reaction overnight. Simply, we're seeing that the Fed's equation, the bets for possible easing coming up, and now 50-50 or is tilt below that because of the specter of inflation. What is your outlook for Fed action going into the new year and the specter of inflation rising?
Look, I don't think we're out of the woods yet, and there's a sense that there may be another shoe to drop. It could be in tariffs or in the labor market, it could be in the asset prices that are quite high in the States. But all of that said, we're quite optimistic about 26. The challenge for the Fed right now is with the government shutdown. We all have a dearth of up-to-date data, which we could do with. It's hard to make these calls of exactly what's going on whilst we're waiting for the information. But as we look further out into next year, I think the resiliency of the corporate balance sheets, the strength, companies leaning in to innovation, investing in AI. There is, I think the doomsdayers will be proven wrong.
We're a couple months out now from when we had concerns rise about, I think there was one at Tricolor, the subprime auto lender. There were failures. There was concerns about non-performing loans. What does your balance sheet look like as far as that, and where is your worries lie?
Our balance sheet is pristine, but I think part of that is because it's very heavily investment grade on the corporate side. We're over 80% investment grade globally. And when we look at the consumer side, it's about 86% prime. So we tend to see the most resilient, healthiest parts of the economy on the balance sheet. All of that said, we haven't seen a thing. that is concerning us. The consumer in the States is being fiscally responsible. Companies have been building up some more cash, either for a rainy day if it proves necessary, but most of them for investment. And they're acting from a position of strength. We'll keep an eye on the labour market. We'll keep an eye on some of the areas of mid-tier players in private credit and the like. But as far as we're concerned, that second, third order effects, the bank's not seeing anything that we're worried about.
Are you concerned by what some say maybe bubble forming in AI? We talked about the advantages of AI, but how much of a bubble or overheating?
I'm not sure if we're just in with a lot of our tech clients on the West Coast. I don't think anyone was ready to say that it's a full-on AI bubble, but no one is saying that there aren't some real pockets of let's call it the British understatement, frothiness in the market. It's more around the edges. What I found interesting is we can see a lot of the demand for the infrastructure build that's going in AI and the energy for the next couple of years. Where you saw some opinions diverge was in the 3 to 5 year period, could we be in danger of overbuilding? But no one's feeling that for the big investments that are going on at the moment for the next couple of years. So I think on that one, certainly some pockets of frothiness there on the valuations, but the core infrastructure investments are important, and as we're seeing in our own bank, and I think many companies are, we'll start getting some of the productivity benefits coming through. But the scale and the pace of investment is unprecedented, that is for sure.
That was Jane Fraser, CEO of Citi, speaking with Bloomberg's Stephen Engle. Coming up, a chat with Michael Green, Chief Strategist and Portfolio Manager at Simplify Asset Management, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. U.S. equities sold off on Thursday after some hawkish Fed speak and a lot more in the way of worry over valuations, especially among AI-related tech. For a closer look, I'm joined by Michael Green. He is Chief Strategist and Portfolio Manager for Simplify Asset Management. Michael, thank you for being here. It's kind of curious because it, at least to me, didn't seem as though we had a strong catalyst for today's retreat in stocks.
I don't have a really strong sense. I mean, the biggest thing that I think we've seen is just a general uncertainty and unease with the narrative that AI was going to turn out to be everything. There's some evidence that is broken a little bit. At least we've broken the back of that move. At the same time, I'm not yet seeing evidence that we have got any form of meaningful retail redemptions or reductions in terms of flow. The most interesting story I heard today is that firms like Schwab started to place some limitations around margin and the ability to access margin on a daily basis. And so that may have played a role.
So would you agree with the statement that the pullback that we saw today, especially in tech, makes next week's earnings from NVIDIA more important than ever?
I think that's right, although I will be very frank with you that I think ultimately NVIDIA's earnings, while they may engender an immediate response, are going to play a less important role in this than whether Americans continue to have jobs and the economy doesn't slow significantly. I'm much more about the flows of investment, and the largest flows continue to be simply coming from retail with contributions into passive vehicles.
So what about the rotation that we have seen away from tech and into defensive names like healthcare and consumer staples? And we know that valuations are a major concern. Are you seeing an acceleration in repositioning right now? And is that really what the dynamic is all about?
I think much less so. So that's part of what I was highlighting in terms of it being a broad day, right? So defensives were down 35 basis points. Strong balance sheets were down 66 basis points. Value, even if I just isolate for the long component of it, was down about 83 basis points. There really was no segment of the market that was untouched. we clearly saw a break in areas like unprofitable technology and relatively recent momentum, which have been leading the market for the past several months. Those clearly we saw sold. It's less clear that we saw significant buying in the defensive areas.
To what extent was hawkish Fed speak a culprit? Because if you look at what some of the major Fed players, and I'm thinking of Kashkari in Minneapolis, maybe to a lesser extent, Musalem from St. Louis, they are still very much concerned about the impact of higher inflation. And I don't know whether or not you feel the same way as they may feel, but clearly the market right now is pricing less than a 50% chance of a rate cut in December. To what extent is the Fed a component here and what we're talking about?
I think that's actually a far more critical component. The pressure that we're seeing on the fixed income space with retreating from the expectations, the nearly 100% expectations that the Fed would cut in December, are not all that different than what we saw at the tail end of last year. And this is something that I've actually written about in advance. I've highlighted it repeatedly. We have a problem with our seasonal inflation adjustments. The COVID dynamics and the Russian invasion of Ukraine threw traditional seasonality and CPI off. That's actually causing many of the indicators, and I'm sure the Fed is tracking these privately as well. It's caused many of the indicators of inflation to actually become atypical seasonally. When you attempt to seasonally adjust them, it shows Q4 and Q1 inflation as higher. My hunch is that this is just wrong, right? That ultimately what we're seeing is a slowing in the housing market, that the pressure from tariffs is now translating to lower aggregate demand. And that in turn means that inflation is likely to be quite low next year. As we come into, April, May, June, we'll see the same narrative shift. Oh my gosh, inflation's nowhere near as bad as we thought it was. And the Fed will again return. But this was exactly the risk, that the Fed was going to become overly conservative and slow in response to atypical seasonality in pricing information.
On the goods inflation side, away from food and energy for a moment, can we assume that the story in China, the deflation story in China, means that China will continue to export deflation?
I think that's a good assumption. I think the key issue that we need to remember with China is that China is increasingly automating much of its production. That means that their productivity continues to move apace in the production of goods. Because China's population is now shrinking, their aggregate demand, it's very difficult to grow that domestically. So you simultaneously have expanding domestic production and flat to down domestic aggregate demand, which we see very clearly in China's import data. As a result, China is forced to export deflation and goods, and to a lesser extent, technological services around the globe, in the hopes of finding somebody else to buy what they want. That's particularly acute in an environment in which the Americans are saying, no mas.
Michael, talk to me about some of the strategies that you're putting in place to protect against downside in the equity market.
Well, fortunately, I have less direct involvement in the equity markets than I do in the fixed income markets. In the fixed income markets, there's two sources of protection. One is rates themselves. Right now, that's working against you because of concerns that the Fed is going to back away from cutting rates, cutting yields. But ultimately, that is a source of protection. Those endogenous cash flows will continue to flow in the form of coupons, et cetera, to investors, protecting their portfolios relative to assets like equities that have very little endogenous cash flow to them. The second thing that we use is a series of proprietary hedging techniques, most of which involve identifying an equity overlay in which we are long companies that never need to tap capital markets, and we are short companies that do need to continually tap capital markets. When you enter into concerning periods in financial distress, that ability to refinance comes into question. That causes the relative performance of those two series to shift in a way that's very similar to credit spreads. And it ultimately offers protection to my portfolio that's worked extraordinarily well over the past couple of years. That's really the primary focus, is making sure that our investors are protected against rising credit spreads. And again, today was an interesting one. We just didn't see that much response in the credit markets.
So we know that the shutdown has meant a lack of key economic data, and I'm curious to get your take on the time that will be required for visibility, adequate visibility to return to help understand not only Fed policy, but what's going on in the broader economy.
Well, I think this is one of the great ironies, right? You never shut down your system if you actually don't have a meaningful competitive advantage. In the private sector, firms like Revolo and Truflation, to a certain extent, ADP, the NFIB, et cetera, those are all providing private sector data that I think many of us are actually looking at and saying, other than the Fed's fixation on the official data, we feel like we have a pretty good grasp on this. So it's, the data that we're getting in some ways, removing the noise of the official releases has caused more and more people to seek out private sector alternatives. My hunch is that those will remain part of the arsenal.
When you speak of private sector alternatives, I'm curious to get your take on what we've been seeing lately in the private credit space. Is that a cause of concern for you?
Well, as a credit investor, that's very, very much a cause of concern on two fronts. One, the absolutely insane growth in terms of capital that was committed to private credit has helped to underpin the very tight credit spreads that we've seen in areas like high yield. Companies that were facing risks of refinancing were often able to turn to private credit firms in order to obtain sources of funds that they might not have been able to otherwise obtain in places like high yield. The second component of it is that we've seen an extraordinary divergence start to play out over the last 6 months, where areas like high yield have experienced very tight credit spreads, even as proxies for private credit have seen their equivalent spreads widen dramatically. There's a divergence that we've really never seen to this degree before in the markets. It suggests that the public sector measures of private credit, things like BDCs trading at a discount, business development companies trading at a discount to their NAV or price to book, are actually somewhat of a value in the credit space because people have been seeking ways to hedge private credit. They've been using publicly traded BDCs to do so. My hunch is this is going to be a little bit of a buy the rumor, sell the news type event. Lots of concerns around hedging have pushed down BDC prices. Private credit itself remains untouched. High yield spreads remain very, very tight, certainly relative to history. There's an interesting scenario in which, as the information begins to flow out, we actually see high yield begin to suffer relative to where we've publicly marked things like business development corps.
What about the use of debt to finance a lot of the build out that we have seen lately in AI infrastructure? Is that a cause of concern for you?
Well, that I think is actually a really big cause of concern because ultimately this has become extraordinarily incestuous. Remember that a firm like Microsoft didn't actually make a cash investment in OpenAI. They largely made a contribution of Azure operating use, which meant that OpenAI had cash equivalents that they could use for purchasing access to data centers and GPUs. If OpenAI can't actually finance its build out, or if Meta or Oracle or others cannot, CoreWeave, for example, cannot finance their build out, that calls into question OpenAI's growth. That calls into question their ability to effectively utilize those Azure credits, which then means that Microsoft could face pressure on the revenue side. So these are all very, very tightly linked at this point. A sizable fraction of US GDP growth is tied into this area. And I think people are appropriately starting to say, hey, wait a second, does this make that much sense?
We'll leave it there. Michael, thank you so very much. Michael Green there. He is the chief strategist, also portfolio manager at Simplify Asset Management, joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.